Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500. Last video we discussed 1973, the rate shock, and I went on a little bit of a rant regarding consensus. Economic consensus, market consensus is what most people agree on. At all times in the market, there are things that people agree on, that investors generally agree and are accepted. And there is a saying that consensus is always wrong, right? Or almost always wrong. Now, I also mentioned the fact that consensus is currently saying that we're heading into a recession, that the economy is slowing down significantly, that the Federal Reserve is tightening into this slowdown, and that historically has been associated with major drawdowns in the market. And this is just one quick chart that illustrates that. You can see here, recessions are the gray bars, and pay attention to the one-year yield here. So basically the interest rate, right? How much the Federal Reserve is tightening. And you can see that generally rate hikes increasing is not too much of an issue. And you can see the black line is the S&P 500. So rate hikes aren't an issue. The market can continue rising as long as the economy is doing well. But as soon as you start getting near a slowdown, right, the gray bars, that's where the market tanks. And we saw that in 1969, we saw that in 1974, 1975, where the one-year yield was rising initially, everything was going well with the stock market, and then you had the gray bar, and then you started to get into a slowdown, and that's where rates were really incredibly harmful to the market, and rising rates caused that severe slowdown. That's really what the consensus is right now, that if I put up the federal funds rate, or even I can put up the one-year yield to make the comparison fair, it's been rising incredibly aggressively. You could argue in a similar fashion to the moves up in the one-year yield we saw in 1969 and in 1973. And consensus right now is recession. We're heading into a recession. We're seeing rates increase incredibly quickly. And so we should expect, at the very least, a 1969 drop, and possibly even a much larger bear market similar to the size that we got between 1973 and 1974. Now, following that statement, the fact that consensus is that we're heading into a recession, we got a little bit of a pushback in the comments section saying that we're not showing enough evidence that the consensus is in fact that we're heading into a recession. And so I wanted to show you this chart right here that is titled "Recession is Now Consensus." This is a chart from the Bank of America Global Fund Managers Survey. So they ask fund managers what they think about the global economy, whether or not they think a recession is likely. Now, of course, late 2007, no fund managers were expecting a recession. It was the furthest thing from consensus. Nobody was expecting a global financial crisis. Now, you can see where late 2007 is. It's right here. It's the top. That's when everyone was all in. The Fed had paused for a while, things were relatively stable, and the Fed was even potentially talking about easing back then, which got a lot of investors very excited and completely pushed out the idea that a recession was imminent. Now, of course, what followed was one of the worst recessions in history as economic data got worse, with most fund managers saying that a recession is likely in March of 2009. In fact, you can see the entire spike right here when this survey really crossed that zero line, where more people are saying a recession is likely than people who are saying a recession is unlikely. That was around in November of 2009. Now you can see where March of 2009 is. Right when consensus was that a recession was likely was right here. And November of 2009 was when people started to wake up to the idea that we were heading into a recession. So by the time you listen to consensus, by the time you pay attention to what consensus is, it's too late. It's been completely priced into the market. And if you act on consensus, you're probably doing the exact wrong thing at the exact wrong time. In fact, you can see here in April 2020, that percentage of fund managers saying a recession was likely was at the same levels of March 2009. Now, of course, April of 2020 was after the market bottom right here. If we measure that up, right before a 70% move up in the stock market. So another big proof that consensus most of the time is wrong. Now, consensus, at least in July of 2022, and I think this is probably worse today, but we'll have to wait for the August data to come out. We're clearly in that rare area where recession is now consensus, where most people agree that a recession is likely. Now, of course, if you're listening to CNBC or other news networks, consensus is all you're going to hear. And that's really what our mission is at Game of Trades, is to give investors a non-consensus view. One of the big driving factors behind our decision making at Game of Trades is to figure out what the consensus is and to really dive into the research regarding whether or not that consensus is correct. Of course, keeping in mind most of the time it's not correct, but we still have to prove that, right? We still have to go through the process of showing whether or not the consensus is correct. And right now is one of those moments where we know what consensus is and our research is currently showing it's completely wrong. So we're positioning that way. We've been positioning that way for quite a few months. Based on this, we provide targets to our members with risk reward that's clearly highlighted. We're going to be adding a model portfolio to the website with the new update of the market, frequent overviews of the opportunities that are currently present in the market with specific entries and specific exits where we think the risk reward is the most favorable. And we try to do that and provide that service for as many people as possible and make it as accessible as possible to the individual investor. So not only do I believe the price is low for the service that we provide, but you can also just test out the service for free and see whether or not you can benefit from it. So if you are interested in that, make sure to click on the link down below. Now let's dive a little bit into the technicals and put what I just talked about into a little bit more context. Consensus can be right for some time, right? And you can see November 2009 to March 2009, the market was falling. It was moving down aggressively, and so people who were in line with the consensus, which is that we were heading into a recession and that investors should be preparing for that, you looked very smart in March 2009. And it was incredibly difficult not to give in. And it might look obvious now with hindsight, but if we replay that moment, it kind of looks like this is a complete market collapse. You've just broken down below the support level from 2000 right here. You're seeing major banks going bust, unemployment levels skyrocketing, and Jim Cramer, CNBC, telling you should be panic selling your stocks. This kind of looks like the Great Depression. It kind of looks like we're heading into this multi-year period of intense bear market. And yet, looking back, it was the bottom. It was the very bottom of the market. So the point is, consensus can be right for some time. And in fact, that's been the case right here since June of 2022. Consensus since around May of 2022, consensus on the market has been bearish. It's been focused on the tightening into a slowdown, and the market has not performed well since then. In fact, that could continue being the case. We could still break down in a similar way to the way the markets broke down in 2009. But you're never going to be able to time the market perfectly. What you can do is go against consensus. Realize that the market is trading at a discount relative to the pessimism that's currently out there. That was the case in November. The markets dropped 30%. It was still the case in March. These were some of the most attractive buying opportunities in history, and that's what we're currently focused on. Whether or not that brings about some pain in the near term, we think that's going to pay off when we're looking back on this moment 6 to 12 months from now. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash that like button and click on that subscribe button if you want to stay up to date on the market. Now, in the meantime, I wish you good luck on your trading and see you next time.